So I want to welcome everyone to my monthly webinar with FX Street. And if you're just joining us right now, this is Lien with VK Forex Advisors. I'm one of the managing partners here at at VK Forex Advisors. And if you got a chance to meet Boris out in Vegas this past weekend, I heard he had a really great presentation. And hopefully he'll be coming back next month to share with you more information on exactly what he covered back in Vegas. So with that, what we're going to talk about today is trading in volatile markets. I did a similar presentation last month on this, but the content is actually slightly different because today what we're going to talk about is more market-sensitive events. Now, before I begin, let me just show you this disclaimer, which, obviously tells you that trading currencies or any leveraged product can be risky. So therefore, it's important to be aware of those risks and kind of get a sense to understand exactly how exposed you are in the markets at any one point in time. So volatility. Well, we've had quite a bit of volatility in the markets over the past month. If you pull up any charts, particularly that of currencies, you'll see that there was a great deal of carnage in the market. And this carnage is caused by a number of factors. Most recently, we had the European sovereign debt crisis and the Greek default come really to head. The possibility of a Greek default has become not from a possibility to a probability, and I think that's just a matter of time before Greece is forced to default on its debt. But what really set the market off was last week when the Federal Reserve kind of talked about how there was significant downside risk to the U.S. economy, and they obviously underwhelmed when it came to a solution for the U.S. economy. So all that to set off some crazy volatility in the markets. And if you've been in the markets for the past year or so, this type of volatility is something that we've unfortunately become very used to. And the reason for that is because the black swans of the world, which are typically things that are considered rare because white swans are quite common, but black swans are much more rare. The black swans of the world are becoming something that is perking up on a near weekly or even monthly or even weekly basis. And so all these things on this list, such as joint intervention in the yen, the March 2011 earthquake, the European sovereign debt crisis, the flash crash in 2010, all those things are becoming a way of life. And for many people, that's difficult to handle because what that has meant for the markets is a tremendous amount of volatility. And unfortunately, the volatility is not expected to disappear anytime soon. And what I want to talk about is kind of the big event risk to be aware of over the next 2 weeks that could really trigger some crazy movements in the currencies. I mean, if you take a look at today's movements alone, and I'm going to switch over to my live chart so we can start looking at some charts. This is a chart of the euro dollar, but I'm going to flip over to dollar CAD. And let me know if you see my dollar CAD chart right now. Yes, no, can you see my dollar CAD chart? Wonderful. So right now, this is a monthly chart of dollar CAD. And you can see here that dollar CAD is basically trading at its highest level since the beginning of this year. So this is a pretty strong move in dollar CAD. And we've also seen, really big milestones reached in other currencies. I mean, for example, Euro Yen is right now trading today at its lowest level since 2001. CAD Yen is trading at its lowest level since 2009. And Aussie Yen is trading at its lowest level since in a year, essentially. So these are really big moves, and they're wild swings. And these moves are unfortunately expected to last. And some of the volatility in the market could very well be caused by these few events that are coming up. The first one that we are really focused on is for this week is going to be the vote in the German parliament about the rescue package for Greece. Now, in terms of the German parliament itself, I think that this is pretty important because what they were looking for is Germany was supposed to vote on expanding the EFSF. But the problem here is that, as you may know, there's a lot of infighting in Germany about whether or not they want to put up more money for Greece. So let's take a look at the Eurodollar because we're first going to talk about all of these big events in the Eurodollar and get a sense of how it can move the currency. So I'm going to flip back over to my Eurodollar chart, and this is the daily chart of the Eurodollar. So you can see here, obviously, that we had a really strong move lower last week. But on Friday and today, we had a bit of consolidation. And the reason why we have a bit of consolidation in this daily chart of the Eurodollar is because people are waiting. They're waiting for some sort of big, the next big announcement or next catalyst for the sort of next move in the Eurodollar. They're waiting for the catalyst for whether the Eurodollar, what will take the Eurodollar towards, 138 or back down to, as for the Eurodollar, back down towards 130. So the first catalyst is going to be the German vote on Thursday. If the parliament votes successfully and they basically approve the expansion of the European Financial Stability Facility, that would be very positive for the euro. Can everyone still hear me? I see someone saying silent mic. Please just chime in and make sure that you can hear my voice. Just say a yes or no. Yes, no. Okay, so I think it's just you, Element. All right, so the first thing is on Thursday. If is a German parliament vote. If they approve the expanded EFSF, this equals Eurodollar back to 138. If they reject the EFSF, it would probably mean Eurodollar back below, Eurodollar to 133 handle. And this is what we're seeing, as a vote of confidence and could really define German Chancellor Merkel's future. Because, we all know that Germany is the largest country within the Eurozone, and they've been the kind of roadblock for a lot of the plans for Greece. So if we do get a successful expansion of the European Financial Stability Facility, what that means is that they're basically increasing the rescue funds for Greece, for Ireland, and any other country that needs it. So that is why it would be perceived as so positive for the euro. Now, whether or not it's going to be approved still remains to be seen, but I think that right now it is likely to be approved, but Germany may announce additional conditions for the scrutiny of future packages. And so that's basically on September 29th. This week, we also have Greece voting. But what Greece is voting on is they're voting on a recently proposed property tax increase that will be seen as a test of whether the country will stick to its past promises to tighten its belt. So, if you take a look at any type of major website, you'll see that there's been some violent clashes or just clashes and protests and things like that in Greece. This will be a test of confidence in Greece as well. So we'll be watching those very closely. And then on top of that, the other big event to watch this week is the Italian bond auction. We have an Italian bond auction tomorrow. Let me just type this in. Tomorrow. And basically, the reason why this is so important is because, we all know that Italy really disappointed when Berlusconi kind of watered down the austerity package. That led to a downgrade by rating agencies. And so this will be the first time that Italy is auctioning off their bonds since the downgrade. So if the bond auctions receive weak demand, that means not many people are buying into the bonds, or they have a lower bid to cover ratio, that would hurt the euro dollar, because it would mean that investors are really concerned about all these troubles and sovereign debt crisis in Europe. So as a result, they are not necessarily going to they're not necessarily going to be bidding up euros. If the bond auction is very strong, and I wouldn't be surprised if it still was, because in the past when we had trouble with Spain and so forth, we still managed to have some decent bond auction results. So if the bond auctions were still strong, that would be positive for the euro. So that's kind of the scenarios that you should look forward to when it comes to the three major event risks this week. The first one being the Italian bond auction, the second one being the Greek parliament vote on the property tax increase, and the third one being Thursday's German parliament vote on the expansion of the EFSF. But the big event risk should really come next week. Now, the reason why the big event risk should come next week is because on October 3rd, we've had the Eurogroup meeting. And this is a pretty big deal, because October 3rd is when Greece expects to receive its next tranche of aid payments. And they said this morning that they believe that they'll receive their next tranche of aid payment on October 3rd. But the Germans came out quickly thereafter and said, we don't think so. We don't think that, we think you're a little bit too ambitious. We think that, there's still a lot of hurdles to overcome, and the Troika needs to, have a much more concerted discussion about this, and we don't think we're going to meet the October 3rd deadline. So that's kind of what caused the volatility in the eurodollar today, because much earlier in the day, the eurodollar was boosted by the optimism that they could actually receive their aid payment by October 3rd, as well as kind of talk of the 1.75 trillion pounds rescue package for the euro area, which we'll get to next. But more importantly, though, the eurodollar kind of trickled lower after Germany came out and said, we don't think so. So October 3rd is a really big meeting. If Greece does not receive its aid payment by that date, they're really going to be at risk of defaulting on part of their loans, because they pretty much run out of money mid-October. And so October 3rd is when they need to get the approval for more aid, and then disbursement will happen shortly thereafter. So this is a pretty big day, and it's a pretty big deal. And so I think that as a result, we could continue to get quite a bit of choppy and volatile trading going into the October 3rd Eurogroup meeting. But the last thing that I wanted to share with you in terms of event risk to really focus on is really the one that I think is the most hopeful. Because this morning we had the UK Telegraph kind of released a little article talking about how the Eurozone could come up with a 1.75 trillion pound rescue package for the Euro area. And this was supposed to be a package brokered by the G20 nations. Now, this package is massive in size and could very well be the answer to all of the Eurozone's troubles, because in many ways it is similar to what was announced in April 2009. So what I was saying was that the November, can everyone hear me now? Okay, good. What I was saying was that let me just fix my camera here. Wonderful. So the November G20 meeting, which is on November 3rd and 4th, really reminds me of what could happen, what could really be the solution for the Eurozone as a whole. And the reason is because this 1.75 pound sterling rescue package really reminds me of what happened in April 2009. And I want to show you first the charts of April 2009, and then I'll explain to you what happened. So this is a monthly chart. Let's just go to a weekly chart for impactfulness. And let me move my chart over. Alrighty, let me just kind of get it all into the screen. Alright, so what I'm going to show you here is April 2009. So I've got my little pointer here, and pretty much this is April 2009, right around here. So this is when this huge sell-off in the euro dollar was when we had the global financial, the subprime crisis. And we obviously, if you remember back to those painful days, the euro dollar just fell. And then there was quite a bit of volatility in the markets, and then it rebounded a little bit as, seemed like there was a little bit of support for the banking sector, but then it collapsed once again. And the euro dollar, moved pretty much as low as around the 125 level. And this low was reached right around March of 2009. And this huge candle here, right around here, was when we had the April 2009 London Summit. Let me show you a chart of the stock market, just to give you a sense of what was going on as well at that time. So I'm just going to pick up this is a representative of the S&P 500, and well, let's see if we can get, basically this lighter color line down here is the S&P 500. And you can see that same story. We had a really huge meltdown in the S&P 500, and it went below 700, and that was right around March 2009, and this was when we had the 2009 London Summit. So if you take a look at what's happening now, we're obviously not at the same levels that we were in March 2009, but to us, it certainly feels like it. It certainly feels like we're in a similar situation because of the banking crisis and the risk of sovereign defaults, and it just feels as bad as that. So what in the world did policymakers do in order to stop this from falling? Well, what they did is in April 2009, we had that summit of G20 leaders in London. And at the time, what they did was they came together and they basically announced a really grand sweeping rescue package. In principle, they announced a $1.1 trillion package designed to improve the financial, credit, trade, and overall economic stability and recovery of the world. And this included like $500 billion worth of increase in resources pledged by, borrowing arrangements, special drawing rights, if you remember, given to IMF members, as well as, pledges to increase trade finance. It was a really, really big deal, and it was basically what stabilized the euro dollar as well as the stock market back in 2009. So that is why I said that the November 3rd and 4th G20 meeting could be such a big deal, because that would be the perfect place to announce this 1.75 trillion sterling European rescue package. Because if that rescue package, which was supposedly brokered by the G20 and therefore be appropriate to be announced at the G20 meeting, was announced then, that would, in my opinion, result in a similar movement as we had back in this area here, which is a really parabolic move higher in the euro dollar as well as your stocks. So, in conclusion, this whole European scenario, I think, we'll probably see going into these votes, maybe a little bit of consolidation in the euro dollar. If the votes in the German parliament go positively, and I think they could, we could see, a bit of a rebound in the euro dollar. But then we've got, obviously, the Eurogroup meeting, and that's really a wild card. It's really difficult to tell whether they're going to be able to band together and release the aid payment for Greece by October 3rd. I'm not really that hopeful. I'm more skeptical than anything else. So if they do not release it, that kind of causes another leg lower, maybe something similar to this movement here. And then we're up to November G20 meeting, and that's when I think that, or at least I really hope that the G20 leaders will do more than just talk. They'll actually follow up talk with some action and help to finally stabilize the financial markets and give us some sort of nice optimism going into the holidays. So that's kind of basically, the volatility inducing factors that could be delivered to the markets. I would not even rule out something that's not just for the Eurozone, but a package that would extend its reach to many other countries, which would be really good because it would help the U.S. and so forth as well. So with that in mind, we've talked a little bit about how you can position for the upcoming event risk. But let's talk about how the markets are in general. And what I'm going to do is I'm actually going to delete one of these lines. See if I can. So what I'm going to do is I'm going to share with you my PowerPoint slide about suggestions and how you can trade in volatile markets. Now, the first suggestion would be to stay with the trend. And if you ever follow any of the work I do, I love to use the double Bollinger Bands, which are the 20-period, 2 standard deviation Bollinger Bands, 20-period, 1 standard deviation Bollinger Band. And let me actually apply this to a live Eurodollar chart. Okay, so we got rid of the Dow. I'm going to apply my Bollinger Bands and show you why it's so important why I think that it's important to stay with the trends in a volatile market. Because the market gets into one sentiment or one line of thinking for a reason and usually stays with that line of thinking until there's a reason to change. So I'm just going to set up my Bollinger Bands real quick here just to show you what we're looking at on a technical basis and how you would stay with the trend in volatile markets. So that's the default Bollinger Bands. I'm going to add in the 1 standard deviation Bollinger Band. Okay, just give me 1 second and we will be all done. All right. So I've got my Bollinger Bands here, and the way to use the Bollinger Bands is I like to say, as a rule of thumb, when the currency pair is in a strong trend, it usually likes to remain, mostly in the 1-2 Bollinger Band. So we see that here. The Eurodollar is in a strong downtrend if it remains in the 1-2 Bollinger Band, the downside. And I like to say that it's in a strong uptrend if it remains in the 1-2 Bollinger Band, the upside. So you can see that the Eurodollar is in, a pretty significant downtrend. And I think that that's pretty important because given that it's in this downtrend, it tells us that there's more scope for losses than strength. So in this case, one of my tips for trading in the volatile markets, or at least what I would do, is I would stay short the Eurodollar in this case until it closes outside of the 1-2 band. So in this case, I would remain short, and it could very well do this because we're so close to the first standard deviation Bollinger Band. But I would stay short until the Eurodollar closed above 136, and that would be the only time when I would actually turn bullish the Eurodollar. In terms of how do I make the middle line disappear, I just unchecked it on my trading screen. Now, the next tip that I have for trading in volatile markets, let me go back to my slide, would be to trade ultra short term. Because one way to trade the markets would be to trade ultra long term. Because if we traded ultra long term, that would basically kind of help us or help shield ourselves from some of the crazy intraday volatility. And if we traded ultra short term, that would allow us to focus on really, really kind of brief movements in the market. So one way to consider trading ultra short term would be to, let me move my slides to the next one. It would be to use something along in the lines of the extreme fade. So what the extreme fade is, and let me, advance my slides. The extreme fade basically also involves using Bollinger Bands. And because if you ever see the work that I do, I really, really love Bollinger Bands. So with the extreme fade, we, instead of using the second standard deviation Bollinger Band and the first standard deviation Bollinger Band, what we use is a third standard deviation Bollinger Band and the second standard deviation Bollinger Bands. So the reason for this is because it really helps us capture the really rare movements in the market. So what we want to do is we want to put the Bollinger Bands in our charts, and we want to add the ADX. Now, ADX is not a complete necessity, but I just like to have it on there, and I think it's quite helpful. But I like to add in the ADX, and I only take the trades when the Bollinger Band goes from the third standard deviation area, when the currency pair touches the third standard deviation Bollinger Band. I'm actually on the slides right now. And what I want to do is I want to watch the currency pair close at or above the third standard deviation Bollinger Band, which basically looks like this. So you wait for the currency pair to rally. You want to watch it close at or above the third standard deviation Bollinger Band. The reason why this is important is because we get into a really extreme move when that happens. So we see that the currency pair closed at or above the third standard deviation Bollinger Band, but you don't take a trade simply because it does that. Then you want to wait for the currency pair to move from the third standard deviation Bollinger Band to the second standard deviation Bollinger Band. You want to look for a close. So basically, let's say we're rallying. Rather than just selling whenever it touches the third standard deviation Bollinger Band, you want the currency pair to roll over and then close outside or below, in this case, the second standard deviation Bollinger Band. So this kind of prevents us from taking these kind of bad trades here. Then, if you want for a higher probability trade, you can check to see if the ADX is less than 25, because that means that the strength of the trend is not that strong. So therefore, it may be a higher probability trade to take. So I want to make sure ADX is below 25. Then you want to, in this case, sell at the open of the next candle. So we short here. Stop at swing high or low, which is usually 15 or 20 pips because we're using a 15-minute chart. And then target 1 times risk and trail your stop, or you can use 2 times risk for a 2-to-1 risk-reward ratio. So let's look at, these are kind of examples here. So we went short here, 80.87. If we went for 1 times risk, we would have closed our position here. And if we went to 2 times risk, we would have closed our position here. This is another example on the long side. You want to wait for the currency pair to sell off. You want to wait for it to close at or below the third standard deviation Bollinger Band. Then you want it to roll over, close outside the second standard deviation Bollinger Band, go long, targeting either 1 times risk or 2 times risk. And let me just show you a live chart on this. I was kind of looking for, opportunities when it closed at or above the third standard deviation Bollinger Band. We don't have any of that in this scenario here. The first time we have it is pretty much right around this region here. So here we actually have some choppy trading. It closes at or below the Bollinger Band, rallies a little bit, but probably ends up stopping us out. Here's a nicer example where it basically closed at a Bollinger Band. We wait for it to rally. Oh, this one, we actually wouldn't have taken this trade because if we look down here at ADX 25 is down here, and this trade was actually when ADX was really high. ADX in this case was around somewhere around here above 30. So that is the reason why we use ADX, because it helps filter out these kind of bad trades. Here we have the currency pair close at or below the Bollinger Band. It rolls over. In this case, when it rolls over, we do have ADX below 25. Then we probably short somewhere around here, and we have a nice turn in this currency. Here's another example, closes at or above the third standard deviation Bollinger Band. ADX is below 25, and then we basically enter at this candle here, going for the reversal. Let's move over to the euro-dollar chart. Let's do the pound-dollar to see if we have an example in the pound-dollar, and then I'll move on after this example. So we're looking at live charts here. So here we have it closed at or above the Bollinger Band, and then when here we basically sell here, and we sell here at around 154.93, and our stop is at the swing high here, 155.05. So basically, I would say it's about a 10 or 15 pip stop, and then we use a 10 or 15 pip first target. The low here is 154.75. we probably would have hit our first target. Here's a nicer example where we do have it closed at or above the Bollinger Band, and then it comes out of the Bollinger Band and gets a nice little reversal. Here's another example. Pound dollar's rallying, closes at or above the Bollinger Band, closes out of here, and you get a little reversal. And you can look for yourself whether for more examples. It's easy to lay these onto your charts. The stop is the swing high or swing low. So the third tip that I have for trading in volatile markets, and let me just actually refresh my screen, is to avoid range trading and to focus on trading breakouts. Because when we do have volatile in the markets, breakouts are really the definition of volatility. So rather than trying to buy low, sell high, I would focus much more on looking for breakout opportunities in the major currencies. And then the fourth tip I have for trading in volatile markets is to be aware of correlated positions, because very often you'll have a scenario such as this, where the currencies are all up against the dollar or all down against the dollar. And we certainly saw that last week in the bouts of risk aversion that we had in the markets. So I would definitely encourage you to look to be aware of that, because when we have highly correlated trades, that can be kind of risky, because that could basically mean that if one goes wrong, your other positions could go wrong as well. This just shows you an example of highly correlated positions and what it would look like. And I'm sure if you were just following the markets on Friday, you would have seen that this was very much the case in the markets. And then finally, my fifth tip for trading in volatile markets is to manage your stops and limits better. You have two choices in volatile markets. You can either widen your stops to accommodate the increase in volatility and take smaller positions, or you can trade ultra short term and use tighter stops. So the first example would be something along the lines of maybe trading using the double Bollinger Bands and widening your stops. The second would be more focused on maybe trading an extreme fade and using tighter stops. So if you have any questions, feel free to ask them. At BK Forex Advisors, we basically provide short and medium-term trading signals, and we are actually running a special right now where you can test out our service for the first month for new subscribers for $99. Our normal subscription service is $199 a month. But for the first month, you can try it out for $99. This is the link there. And I encourage you to go onto the website and take a look at that. As for your questions, let me see. One of the first questions that we have here is, what do you make of the recent decline in the Aussie dollar, and do you think it's related to calm dollars and dollar strength, or is it worries about China? Unfortunately, Paul, it seems to be a combination of all of these factors. It is the decline in commodity prices. I mean, gold prices have fallen very, very sharply, as well as risk aversion, which is why people are flocking into the safety of U.S. dollars, and also a tad bit of concern of Chinese growth. But I think it's more the commodities as well as dollar strength that's driving the movement in currencies. What are your thoughts on Euro Swiss? Do you think it's okay to go long since we'll never go below the floor set by SMB? Well, I do think that this floor set by SMB will hold for a very long period in time. And I do think that going long on dips towards 120 is probably a higher probability opportunity than trying to fade the SMB. Where on ADX do you go long and short? ADX just simply measures strength of trend. So in the extreme fade example, we just want ADX to be less than 25. Gold fell because of CME margins, and today the Chinese margins were spot. And that's true, but it just keeps on falling, and it's not good for the Australian dollar because there's obviously a lot of gold producers in Australia. When you take a trade, do you consider the fundamentals, or you just follow the Bollinger Bands? I'm a big believer that price reflects the fundamentals, and so the sell-off in the Eurodollar and the Bollinger Bands is a reflection of fundamentals. But Rami, we always consider both fundamentals and technicals on our trades for BK Forex Advisors. Your thought on dollar Swiss? Well, dollar Swiss is trading very much like Euro Swiss, and so I think we're probably not going to see too much downside in dollar Swiss. What is the period and smoothing period for ADX? Well, basically for ADX, I use the standard default settings for ADX, which is 14th length and 14th smoothing. For the number one tip, stay with the trend. Last Thursday, the euro closed within the first standard deviation Bollinger Band. Would you have, the question disappeared. Will you go long there? Well, let's pull our chart back up. Euro dollar. And let's flip back over to the daily chart. Okay. So this is a daily chart. Doesn't seem to be an accurate daily chart. I think we're still on my 15-minute chart here. Oh, so actually, I saw the third standard deviation Bollinger Band there. Let me add in the second standard deviation, the first standard deviation Bollinger Band, which was what we're missing earlier. Okay, so now we have the second standard deviation and first standard deviation Bollinger Band. So you said last Thursday, the euro dollar closed within first standard deviation Bollinger Band. On this chart, you can see that we would not have gone long here. Okay, let me refresh the chart. There you go. We would not have gone long last Thursday, but we probably would have gone long on this date here and been stopped out. But in general, though, it usually keeps us within the trend. Next question. By the way, ADX MetaTrader is a lot higher than normal ADX. That could be true, but I do not use MetaTrader. Well, I do use MetaTrader, but not often. Do you use the COT report for positioning? If yes, how do you time your entry? I look at the COT report, and I always kind of am mindful of that, but I don't actually use it to make trading decisions. Any other questions? Why use Bollinger Bands as seem to lag? All technical indicators lag, and there are people who like many different types of technical indicators. The double Bollinger Bands is just my favorite because I found pretty great success with it, and it's what I've been using for a very long time. Any other questions? I think when it comes to dollar Sing, how dollar Sing moves is really going to be based upon risk appetite, because the Sing dollar is a risky currency because it's one of those currencies where it's very sensitive to the global economic cycle. The reason why we've seen such strength in dollar Sing recently is because we've also seen quite a bit of risk aversion in the market. So I think that as long as investors remain nervous, that will be positive for dollar Sing. If they get a little optimistic, that will be negative for dollar Sing. And in fact, if you pulled up a dollar Sing chart, you'll see that the Bollinger Bands the currency pair abides pretty well by the Bollinger Bands. Throughout this move here, it's remained firmly in the uptrend. Any more questions? If the Germans won't pay up, let me just refresh the chart. If the Germans won't pay up, then why is euro getting stronger now? Because, there's a lot of back and forth. Right now it's all in the rumor mill. And the markets are really hoping for some sort of concrete rescue for Germany. Sorry, not for Germany, for Greece. They're hoping for some sort of concrete rescue for Greece. And so that is why we're seeing so much volatility in the markets. And that's what this presentation is about, which is that the volatility, unfortunately, is probably going to be here to stay as people go from one rumor to the next and just kind of respond to it, given that they really don't have too much to react to. Outlook for the Aussie dollar, please. Well, let's pull up an Aussie dollar chart real quick. You'll see, and let me just refresh my camera, that the Aussie dollar is also firmly in a downtrend. It's in the 1-2 band, the downside. Now, we do have a lot of long wicks in the Aussie dollar, right around the lows established in March 2011. And so it does kind of scream a little bit of a bottom. I do think we may have a little bit of a relief rally towards parity, but until it closes above the first standard deviation Bollinger Band, above 101, I would say, I would look at the rallies as an opportunity to sell at higher levels. When using the Bollinger Band strategy, do you trade in the direction of longer-term trend in the daily? Yes. Usually, what is the graph period that most suits double Bollinger Bands? I like the daily the most, but the 4-hour also works pretty well. The strategy is all products. I can use it on gold. Well, why don't we take a look and see how it's performed in gold? So this is a chart of gold, and you can see in this huge uptrend here, it abided by the Bollinger Bands really well. When it moves to the downtrend, it's in there. When in these periods, it likes to stay in there for quite some time. So you can see here that it does like to, even if I pull back my chart a little bit, that it does like to abide by the double Bollinger Bands uptrend, downtrend rules. What would happen if Greece gets out of the euro? Well, if they get Greece being kicked out of the euro is more one of those short-term pain, long-term gain scenarios. And so I think that we could see some short-term pain in the euro dollar, but it would resolve one of the biggest problems of the eurozone and maybe even lead to some long-term gains. So I'm going to take Boyke's question, and then I'm going to end here because I need to move on to another conference call I have had. What would happen if Greece gets out of the euro? Actually, I did answer the question already, so we can just kind of move on here. Once again, I want to thank all of you for participating in this session. And like I said, we're running a really, really nice special. It's the first time ever for BK Forex Advisors in terms of a $99 trial subscription. And I encourage you all to click on that link and take a look at our special. Thank you so much, and hopefully I will be speaking with you soon. And if you don't already follow me on Twitter, I am tweeting throughout the course of the day, and I encourage you to follow me at Kathy Lien FX for my intraday thoughts. Thank you so much.